Welcome to Bloomberg ETF IQ. I'm Scarlet in for Matt Miller.
And I'm Katie Greifeld. And Scarlet, this is the last week that matters, at least when it comes to 2023.
So, of course, we're going to talk about the things people can look forward to in 2024.
Absolutely. Let's get right now to it. Two of the biggest stories right now in the more than $10 trillion global ETF industry. And as we said, it is a packed week with economic data and central bank decisions that will test optimism among investors and lay the groundwork for 2024.
In a few moments, we'll be speaking with Ugo Egbunike. He is fixed income specialist at Jane Street to discuss using ETFs as liquidity and trading tools.
And as we gear up for the holidays, we'll look at two ETFs that bet against physical retail scores. And Scarlet, as always, we have Eric Balchunas from Bloomberg Intelligence here with us now, taking a look at the flows. Eric, what do you got?
Katie, Scarlet, thank you. People gearing up for the holidays, investors gearing up for this nice market. We've seen a lot of flows into equities over the past month and a half, 2 months, and it is continuing. IVV at the top at $4.3 billion in a week. That is a lot of money. Could be BlackRock's model. Usually to come in that big, you need something extra. Look at the month, though. $9 billion in a month is ridiculous. That's a lot of money. That means IVV is now $36 billion for the year. It puts it neck and neck with VU. Now, VU's won the flow crown the last 3 or 4 years, so this is an interesting sort of subplot to watch in the flows. SPY at the top two. You've also got IYR, EMB, XLK, a tech ETF. So generally pretty bullish. Let's look at the outflows. The top, you're going to see the Qs. You don't love to see that, but the Q's still positive for the month. But look in this list here. You've got IEF, SHY, SHV. Notice half of its treasuries. Treasury ETFs have seen outflows in November for the first time in many months and are now seeing outflows in December. So if you're bullish equities, that's a good sign. People are putting more money to work and taking them out of treasuries. So since we have Jane Street on the show, I thought we'd look at volume. You know, volume is an important part of ETFs. Is why they were designed by the Amex back in the day in the first place, was to get trading going. And look, they've traded $35 trillion worth of shares this year. And you can see it's a step down from last year, but typically ETF trading goes up with there's volatility. So less vol, less trading. So we're about even with 2021. It'll probably be the second best year. But look in general, even though these years aren't volatile, we'll take that one out. Look at how much more the volume is on a regular basis than it was only 6-7 years ago. So we have really hit this new normal of volume, and ETFs now make up 30% of all equity trading. So this is good news because volume tends to portend flows. So the more we see volume, the more that board should get updated as well, Katie.
All right, well, let's join our conversation now with Ugo Egbunike. He is fixed income specialist over at Jane Street, joining us on set. And let's start with that chart that Eric just showed us. Obviously, it feels like volume really took off in 2020, ETF trading volume, and it really hasn't stopped, even though this year is a little bit of a step down. Who would you say is behind that volume surge that we've seen? Can we identify a specific group that's really driven it?
Well, I think it's widely across the board, right? So when you saw 2020 sort of develop itself with this growth in ETF volume, a lot of that was driven by asset owners within the institutional space that were sort of discovering this ETF asset class as a means of accessing liquidity. Obviously, 2023 volumes kind of pale in comparison to what we saw in 2022 and 2020. But it's important to note that a lot of that, too, is driven by sort of the rate environment, right? So there isn't really this drive to engage in asset allocation. Frankly, when you could have gotten 400 to 500 bips inside of 2 years looking at rates. Right? I think now that we've seen sort of what looks to be a pause from the Fed, you're starting to see investors take note and think, all right, it might be time to leg out of shorter term rates and start to take on duration risk, whether I'm doing that with risk assets or looking at longer duration treasury ETFs.
So Eric made the connection between volume and volatility. With volatility coming down, things being kind of quiet, is that a good or bad thing for institutional investor presence in the ETF industry?
You know, I think overall it's still a good thing because you have institutional investors that are now more willing to look at the tools that are available to them. And one thing I think that's really important to point out when you look particularly at the fixed income ETF ecosystem is what the underlying asset class looks like from a corporate bond perspective. So we're at a point now where U.S. corporate bond debt outstanding is north of 12 trillion. That's about 10 trillion in IG bonds and about north of 2 trillion in high yield debt. And when you look at that compared to primary dealer net positions, right, so what the bulge brackets tend to hold, it's a fraction, right? The bulge brackets used to be sort of the holders of these debts and the liquidity providers that the buy side would come to at the end of the day. So we're at a point where the question is, where does this debt sit? And it's with the buy side. So the impetus is with them to really understand what are the new ways to access liquidity. And part of that certainly is fixed income ETFs. Another part of that is bond portfolio trading.
Yeah, and you call them portfolio trading. I called them zipper trades. Have you ever heard of that? Is that the portfolio trades seem a little generic. I like zipper trades, but either way, doesn't this really mean that the ETF is sort of the new bond dealer?
In some ways, I don't like to think about it as a replacement. I like to think about it more as sort of a pillar that exists within this new bond ETF ecosystem. So one, you've got the growth of fixed income electronic trading, which is about 45% of overall bond trading. You've also got the growth of bond portfolio trading, and in tandem with that, fixed income ETFs. But it's important to note that, yes, of course, that creation redemption mechanism exists within the fixed income ETF universe. So yes, you do have buy side and institutional clients that are now able to access the liquidity that exists in this ecosystem, whether they're trading fixed income ETFs or trading bond portfolios that look and feel like these fixed income ETFs.
So how big could portfolio trading actually get? Because I remember, this was billed as one of the next big things, both in what you see in debt trading, but also the ETF world. I think that the high watermark is about 8.4% or so of total bond trading activity. It feels like we've stagnated a little bit below that. When you think about the future of portfolio trading, I mean, where do you think a fair number is?
It's really hard to peg where that fair number should be, because I think it's important to note it's only recently that we had trace identifiers to actually mark that this particular bond that traced was considered part of a portfolio trade. So even for us, engaging in the exercise of how big this universe is a little difficult. One thing I will say is when you look at 2022 volumes relative to 2020, the growth rate there for bond portfolio trading that we saw directly was north of 160%. As it stands right now, we're still on pace to outdo the trading that we saw in 2022, but I would say it's leveled off quite a bit. That's not to say, again, that it can't pick up, but really it's indicative of sort of the rate environment, flows that you saw across the corporate bond space, and, frankly, institutional clients kind of sitting on their hands for a bit.
I got to look ahead to 2024. Sometime in the first quarter, the Bitcoin ETF or Bitcoin ETFs are going to come out. Is the industry prepared? Is everything good to go?
I would say from a market making perspective, we've certainly thought about this for many years. And that includes, looking at how the spot market operates, the different venues in which you will need to be able to access liquidity. But, without going into too much detail, given some of the discretion required with the conversations we're having, I would say that the ETF issuers are very, very considerate of what they need to do in order to be prepared. And you're not going to see a launch without some orderliness. So, the folks are working behind the scenes, but from a liquidity providing standpoint, we've certainly been thinking about it very deeply.
Just real quick to, last question here is one of the things with liquidity is a lot of people get focused on on-screen volume. So the top 10 most liquid ETFs account for 50% of all ETF volume, right? There's like volume inequality. Do you struggle when you have clients call that, hey, you can actually use the basket as a liquidity source? You don't have to trade SPY and IWM and all these ETFs that came out in the 90s. You can actually trade these new ones because you can use the basket?
Absolutely. And I think as frustrating as that might seem on the surface, that's still indicative of just the pure growth that you've seen within the fixed income ETF space, right? There's newer players coming to market, not only transacting, trading, and investing in these funds, but also bringing these funds to market. So we're still seeing traditional asset managers coming into the space, engaging their PMs, thinking about ways that they could bring over these traditional mutual fund strategies into the ETF wrapper. So all that's to say, really, that yes, it can be a little frustrating kind of explaining to folks that there's this underlying layer of liquidity that exists, but it's also indicative of the fact that you have new players that are finally realizing it's a valuable asset class and wrapper to have at their disposal.
All right, Ugo, it is great to see you, especially in person. Hope to talk to you again in 2024. That is Ugo Egbunike of Jane Street. Now, coming up as 2023 draws to a close, so do many ETFs as the pandemic trading boom fizzles out. That's next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with the best performing ETF this year. The ticker there is CONL. This is 1.5 times leverage exposure of Coinbase, which has had a fantastic year. As a result, we're talking about a total return of about 430% over the past year. You compare that to SPY, up a pedestrian 22%. Obviously, Coinbase having a great year. Also having a great year, at least when it comes to investor interest, is EM debt, emerging market fixed income. You're taking a look at the biggest EM bond ETF right now, that is ticker EMB. It's on track, or it just closed rather, a 6th straight week of inflows, taking in about $700 million last week. So clearly a lot of investor appetite for EM debt. And since it is almost the end of the year, let's talk about one of the trends that's been developing over the past 12 months, and that's when it comes to ETF launches and closures. As you can see in orange there, I'll call that orange, we've had record launches this year, 450 ETFs. We're actually also seeing, on the flip side, the second worst year when it comes to closures. 234 funds have shut. So this is both a boom and a bust story, Scarlet.
All right, so I want to focus on the bust part because I like to see the glasses half empty. Let's talk about this issue with Bloomberg's Vildana Heinrich. Vildana, great to see you again. What's behind the bust part of it? What are the themes behind the ETFs that are closing up?
So I think this is a really interesting, so far untold story of what's happening in the ETF industry, which is that we have a lot of closures of funds that had either launched during the pandemic or been really popular during the pandemic. So if you look at the list, something like more than 10% of all of the closures that we've seen so far this year have been pandemic era favorites or pandemic era darlings. So something like 7 ETFs that had focused on cryptocurrencies, which we know were a huge thing during the pandemic. We had some focused on NFTs, for instance, that closed. The metaverse. I think the most telling one of this whole story is that a direction fund focused on messenger RNA companies. So Pfizer, for example, the companies that were creating the COVID-19 vaccines, that one also closed. So that was sort of like the telltale sign of this theme of closures.
You also saw the meme ETF close as well, which again is another sign.
And
of
Gen Z, the Gen Z ETF closed. So we lost a lot of really good tickers.
Yeah, that's for sure. But let's talk about the happy part of this story, which is the fact that you have seen a ton of launches come through. Is that any specific type of ETF there? What's going on?
It is, and this is super interesting too, because over the last 2 years, we've had something like 700 funds come to market, more than 700, something around 750. And then still this year, we had a tremendous number of new ETFs come to the market. A lot of them have been actively focused. And that's because we've been seeing flows going towards those types of funds. A lot of them, they might not be what we might typically think of as active funds. They sort of are passive mimicky, if we can call it that. And Katie, you've covered this quite a bit. But it's because we've seen ETFs that have different options, overlays over them that have been so popular this year, taking in billions and billions of dollars. JEPI, for example, has JEPI, has been so popular with investors that we just have a lot of issuers trying to mimic or trying to come up with different ways to also put products out that are geared towards this type of strategy.
And of course, active funds can charge more as well, so that's something in issuers' favor. In terms of themes to watch out for next year, you mentioned crypto earlier, but the Bitcoin ETF is obviously top of that list, right?
It really is. One of the key deadlines that we have coming up is actually just a month away, which is the ARC21 shares final deadline for its application is actually January 10th. So the SEC, we are hoping to potentially hear on the Bitcoin ETF either before then or sometime around that date.
And maybe it'll be plural as well. Vildana Heinrich, thank you so much. Bloomberg's Vildana Heinrich. Now, still ahead, we drill down into capital growth with David Giroux of Rowe Price Investment Management next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlet along with Katie Greifeld.
Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we are looking at TCAF, which is the T. Rowe Price Capital Appreciation ETF. This is a kind of a classic actively managed fund. You can see here actively managed. Yes, people know T. Rowe Price for being active. Just came out 6 months ago. The fee is low, 31 basis points. This is part of a new trend of low-cost active, which is actually working. That's why we have so many launches and flows into active this year. $500 million is pretty good for the asset so far in 6 months. Let's look at the holdings. So this fund looks at both value and growth stocks. It tries to come up with 100 stocks, so it's fairly concentrated. It looks at fundamentals and also where they're pricing and where good value is. The top holdings are pretty familiar. You've got Microsoft, Apple, Google, Amazon, NVIDIA's in there. And you go down, it gets a little less familiar. Now you think, okay, this is overweight tech. It's actually not. It's actually slightly underweight tech and communications, overweight utilities, healthcare and industrial. So you got to dig deep to look at this fund. I think when you're doing active, you want to really look under the hood. Let's look at the performance of this versus the S&P 500. That's what most of these funds get benchmarked against. It's almost a tie. Again, it's moving pretty similar, 50% active share to the S&P. So it will deviate a little. This thing is designed to get more risk-adjusted return over the S&P. Right now, too close to call. But Katie, over time, this thing's looking to outperform. That's when I think the real flows will come.
All right, Eric, thank you. And joining us now is David Giroux from T. Rowe Price, who manages this ETF. And before we get into the holdings and the performance, let's talk about the actual wrapper here, because this is a fully transparent, typical ETF. When I think about T. Rowe's lineup, I know that you guys had debuted a bunch of funds that would fall under the semi-transparent wrapper. Why the change? Why go fully transparent with this one?
Well, I think that's what the marketplace wants, in all honesty, right? I think semi-transparent ETFs have not had the flows that active or more transparent ETFs have had. And so I think that's probably, honestly, the easiest answer.
And of course, a lot of other issuers are going through this journey as well. What have you learned through the process of transitioning from semi-transparent to transparent?
Well, I would say, in all honesty, I never ran a semi-transparent ETF. I'm probably not the right person to ask on that. I've had 6 months now of running the TCAF strategy. That's been the focus, really, honestly.
And let's talk a little bit about active share. This fund has a 50% active share, which means it's 50% overlap with the S&P. There's definitely been this sort of veering away polarization. You're either really high active share like ARK, we call those shiny objects or hot sauce, and then the other ones are really low active share, like DFA and Avantis, have low active share but low expense ratios. Where is this going? It's almost like it's halfway in between both.
Well, what I would say is, we're trying to just create a really compelling value proposition for clients, right? So what we believe and what we've been able to achieve in capped equity sleeve over time is we can generate over 100 bips of alpha after fees on the equity side. We can do lower risk than the marketplace, probably 3 to 5% less risky, and be more tax efficient than the S&P 500 product. We think that is pretty innovative. We think that is disruptive, and we think it's a pretty easy value proposition for clients, right? Higher return, less risk, and more tax efficient. I think we can hopefully take a lot of assets away from what I call lazy S&P 500 index strategies.
And David, I don't need to tell you that 100 basis points of outperformance is no easy feat. So let's talk about a little bit what you have in here. I see 100 holdings, so a pretty small portfolio, all things considered. Where do you see the best opportunities right now when you look across the equity market?
Yeah, happy to do that. What I would just say, again, if you think about, I've been managing the CAF equity sleeve now for 17 years. Over those 17 years, we've actually generated 425 bips of annual outperformance. We've outperformed the equity market 15 out of the last 16 years. So when we look at 100 bips of outperformance in TCAF annually, which we're promising, we're actually ahead of that. We're actually ahead about 65 bips ahead of the S&P 500 year to date. Since we launched the strategy, we're actually ahead of that 100 bip plan. So we feel very, very good about that target of 100 bips of outperformance annually. What I would say in terms of where we see a lot of value in the marketplace today is in some of the areas that have not run. We see really good value in healthcare. We see very, very good value in things like utilities. We see good value in industrials. I would say we see less good value today in tech, less good value in consumer discretionary, less good value in financials.
Okay, real quick though, speaking of, I get all that. People have been seeing value in those areas for a long time, but then the Qs and the Super 7 just seem to roll over everything. every time you think value's back. How do you deal with that? Like, is it tempting to just go heavy into the Super 7?
No, we have zero interest in doing what the market wants us to do, right? If you think about it, a year ago in CAF, or the CAF appreciation strategy, we were overweight tech, we were overweight NVIDIA, when actually, if you think about the momentum stocks of last year were utilities and healthcare, and we were underweight those areas, some parts of those areas last year, right?
Yep.
So we're going to go where we see value, right? We're usually doing the opposite of what the market wants us to do. Again, at the end of 2022, or end of 21, tech was our largest underweight. Tech got blown up. We went overweight.
Yep.
And now tech's done really well. We're doing the opposite. So we don't really care about what the market wants us to do.
Right.
If you want,
David, thank you. We got to leave it there. David Giroux of Rowe Price. All right, before we go, a special look at another ETF as we get ready for the holiday season.
It's the holiday shopping season, and ProShares offers two ways to wager on the retail landscape. You've got the decline of the retail store ETF, also known by its delightfully evil ticker EMTY, and there's also the long online short stores ETF that trades under the ticker CLIX. They both cost 65 basis points, but take different strategic approaches against stores. EMTY is a fund for daily trading that offers short exposure to an equally weighted index of brick-and-mortar stores, like Foot Locker, GameStop, and designer brands. Meanwhile, CLIX combines a 100% long position in retailers that primarily sell online, with a 50% short exposure to those that rely mainly on revenue from physical stores. Its long exposure is to companies like Amazon, Alibaba, and eBay, and shorts the names found in EMTY. CLIX holds about $20 million in assets, while EMTY is trailing with about $10 million. In the Bloomberg Intelligence traffic light system, CLIX gets a green light with a warning about hidden fees, while EMTY gets a yellow light with 3 warnings for inverse minimal leveraging and its alternative weighting.
And of course, before we get to the holidays, though, Eric, we have a great ETF event happening at Bloomberg HQ this week.
Yes, this Thursday, ETFs in Depth. It's about our 10th annual version of this. You will be there. We're recording a live Trillions podcast with Joel Weber, with Hester Pierce, SEC Commissioner. Should be good.
Yeah, you know who won't be there?
Yeah,
Scarlet.
She was invited. She declined, respectively.
Yeah,
I apologize to all the ETF nerds out there.
We'll just miss you.
Next year.
All right, well, if you just can't get enough of ETFs, a reminder that you can listen to Eric and Joel Weber on Trillions. It's their podcast that covers the industry. But that does it for now for Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlet and Eric Balchunas.